Hello, everybody. Mike Sorrentino here, along with Bepin as usual. Welcome to Market Pulse. And the subject of this week is the art of getting it wrong. They always say there's an art and science component to most things, when it comes to this business, Bepin, I mean, I think when I got into the business, I was excited because I thought I was going to make a ton of money. You want to know why? Because I'm a pretty analytical guy. I was always good at math. I was always good at engineering. That was my education. And I figured, okay, well, I've got this analytical toolkit. Making money on markets is going to be easy. It's third grade math. But probably, I don't know, not that long into it, I realized how wrong I was. And this is when I was younger and dumber. And the art of this business, I think, is where most people are wildly successful. So I think that's the appropriate subject for today is the art of getting it wrong, because man, have we seen a lot of just bad, wrong forecasts this year.
Yeah.
And there's no better way to start today in this presentation than one of the better quotes out there from John Kenneth Galbraith, who is a famous economist, I believe a Canadian economist from
Canadian
back in the
American.
day.
Yep. Hmm.
Yes, yes. The only function of economic forecasting is to make astrology look respectable. No offense to anybody out there that still
Yeah,
looks
I
at
was
the
gonna say.
stars, but this is 2025, and I think that quote is absolutely perfect. Uh, there are so many economic jokes that come to my mind right now, or jokes about economists, and I don't mean to rip on them. It is not an easy job, but at the end of the day, I think the problem with economic forecasting is that, again, you think about economics as being supply demand curves and a lot of math and a lot of science. But if you think about what is the genesis behind the subject of economics, it is the study of human behavior. That's what it is. Econ 101 teaches you first day we are all self-interested, and that drives the decisions around economies of small groups to large countries. And because of the study of human behavior, I don't know of a single Excel model out there that can forecast how people react. It's like my little daughters. I got the cutest little 6 and 8-year-old daughters out there, happiest girls in the world, but they turn into total nightmares out of nowhere for no reason. And then they flip switch 10 minutes later, like it never happened, and they go on living their great lives. I'm around these girls all the time, and I have no idea when it's coming. Completely unpredictable. And I think it's a perfect allegory and a perfect example of what we're seeing in the markets this year. Bevin, if we go back to April or even March of this year, when we had Liberation Day and the tariffs and all this craziness, of which I would debate that most of us, and I say us not just on the call, but like us as investors out there, have forgotten a lot about the turmoil that we felt earlier in the year.
Yeah.
All right. But what happened? What happened to all those geniuses on Wall Street during all that turmoil? They started cutting their estimates. They started saying, okay, well, the S&P is going to do this, all right, on the left-hand side at the beginning of the year. Oh, well, now we're going to start cutting, and we're going to start cutting. Oh, tariffs, let's cut them. Liberation Day, panic in markets. Oh, we're heading into a recession. And then what happens? Things calm down. Trump changes his mind. He starts negotiating, and then the estimates start coming back up. And it's not just one bank. It's not just one person. All of them. They all did it. Most of them, at least.
Yeah, I was gonna say shout out to Morgan Stanley. If you'll see, they're the gray line there. Just
Yeah.
straight across. Didn't budge.
Which is hilarious because
Yeah.
Morgan Stanley, he's usually the one that is by far the most bearish on the street. By
Yeah.
far. So I don't know. I don't know what was going on there. But look, I used to work in this world, and I used to work for one of the most famous strategists out there. I don't think his name is on the list. His name is not on the list right here. But uh, I used to give him a hard time because he'd come out with these forecasts at the beginning of every year when I worked on the sell side. It was when I was at Sanford Bernstein, and then same thing at Barclays. We had a great strategist. I'm like, why do you do this on January 1? Why do you keep forecasting this stuff when you know you're going to be wrong? And you know what? One of the most famous strategists of all time on Wall Street told me? Is it because they pay me a ton of money to do it?
Yeah, I was gonna say people care. People really, really care about future forecasts.
Yeah, look, these things like I mean, I'm not trying to say ignore them. All right. I think there's actually a lot of merit into reading what a lot of these strategists are saying. Okay. And I do every year. I know you do Bepin as well too.
Mhm.
And all right, if you run a business, the best thing you can do at the beginning of every year, every fiscal year rather, is to sit down and figure out what do your expenses look like over the next 12 months? What do you think your revenue is going to be? Those two numbers are always going to be wrong. But the mental exercise of thinking of the different levers of your company and how they're going to impact your bottom line is a very, very useful exercise. So I think from an investment standpoint, even though we see these numbers moving up and down, we know they're going to be wrong, but it's interesting to get these viewpoints and then aggregate them together. But the point I'm getting at here is you can't take this stuff too seriously. I mean, look at this chart. I mean, this is objectively funny if you look at it through a certain lens. And it's not just targets on S&P 500 earnings. It's also recession indicators, right? I mean, we've been talking about this for years, Beth. I mean, go back to 2022, if I remember correct. No, I know what
Yeah,
it
the
was.
end of 22. Yep.
End of 20, exactly. 99% probability from the conference board. 99% probability that we would end a recession. Guess what happened? We didn't get into a recession. And again, we're looking at it this year. Here's the recession forecast or prediction of a recession. What are the odds we end up in a recession? This is a wild ride. This is a roller coaster ride. Look at it back in April. 70% chance.
Yeah.
Didn't happen, obviously. And now we're down below 10%, 6% chance we're going to end up in a recession.
And another highlight of this chart here is the last chart we were showing you as professionals, the poly market, which is the chart you're looking at here. These aren't professionals. In some cases, sure, there's some professionals that will dabble in here, but for the most part, this is investors. These are retail. This is just general investors and what they think, and it just highlights how bad humans are at forecasting across the board. It's not just the pros; it's the Joes too, especially the Joes. So, just a futile exercise to try to predict the future of a complex system.
It leaves us to where we are today. I know every year we talked about this. We talked about this a couple weeks ago too. September tends to be a terrible month. We'll see what happens. So far this year, I don't think anybody's really complaining all that much. But if you look at an average year, okay, so that's that light blue line um, throughout a year.
Yeah.
And in an average year for the S&P 500, you do tend to see a little bit of, kind of pain or bumps along the way going, from in September. But what tends to be very consistent over time is October through the end of the year. We tend to see some pretty good gains. It's not the best time of the year for the market tends to be these few months ahead of us.
Yeah.
So much that the Bepin, I think I'll give you credit here, has coined the phrase Uptober.
Oh,
Uh,
I'll give that credit
entering
to
in
Matt Paul. That was not me. I stole it from him.
See, we try to make sure we cite all of our work here, ladies and gentlemen. So Uptober from Matt uh, is a great name simply because it does, as you can see that blue line going into this time of year, which tends to be very positive. What I think is even more encouraging, again, if we believe that history can repeat itself, which sometimes it does. The first year of a presidential cycle, that's that black line, that darker line on the chart. And as you can see, going into where we are today and go forward basis, it tends to be even better. Now, again, there's a myriad of reasons for this, and we can kind of hypothesize and guesstimate what they could be. Past performance does not predict future returns, but like I said earlier, a lot of times history rhymes for various reasons. So we're not short-term traders. We're not saying the market's going to be great for the next 3 months. It's locked and loaded, and to double down or back up the truck or whatever phrase that Jim Cramer wants you to kind of take from him. But my point here is very simple: is that this time of year tends to be strong. We're at all-time highs. Valuations appear high on a historical basis. All these little things out there that are trying to scare us all. But ultimately, when we look at the odds of a recession, not necessarily from poly markets, but from our own work here, and we see the opportunities going forward for earnings growth, it's hard to say what's going to happen in 3 months, but things look pretty good on a go-forward basis for U.S. equities.
Yeah, and then they've been calling this one of the most hated rallies, and for a reason, for the reasons you mentioned earlier. There's just so many fear tactics being thrown out there that gets you to think like, why are stocks still going up? Why are the markets still roaring? And well, let's look at one of the biggest reasons why that's the case. And what we saw last week was the Federal Reserve set their policy rate a 0.25% lower. First rate cut since 2024. I know we've talked about this in previous episodes, but typically when they start cutting, pause, start cutting again, tends to do very well for stocks and bonds, obviously, for that matter, as they're a lot more interest rate sensitive. And along with the rate cut we saw, we also got an estimate from the Federal Reserve on like what the future path forward is in terms of their expectations. It seems that the market and the Federal Reserve are on board for cuts in the next two meetings. That'll be in October and in early December. And that should bring us down to an end of year level of around 3.75 to 3.5. As we know, the Fed does these ranges, they don't just do a fixed rate. And the more interesting part is kind of the 2026, like where the Fed saw interest rates going by the end of 2026. The Fed, ironically, only thinks one cut coming next year. The market is pricing in closer to three. I don't know about you, Mike, but I'd be pricing in even more than that. And just off the thinking that we're definitely going to get a very rate cut friendly Fed chair starting next year. It'd be shocking if we didn't. And obviously, one person can't just set policy rate, but it does seem that that momentum is building. That people want rates lower. And my guess is that they're going to be, I'd be willing to guess that they're going to be lower than the target that the market or even the Fed has at 3% there. But obviously, that's to be seen. Like we've been talking about earlier, forecasts are almost useless. So, same thing with the Feds, even the professionals. I think we've actually joked about it in the past, looking at the dot plots and how wrong they've been over time, how much they'll change in a 3 month or 9 month period. So it's just a prediction, but the general I'd say that this isn't so much of a prediction is that rates are coming down. We might not know where the final level gets to, but we're very sure about the direction that they're heading, which is lower. And the next chart you're going to be looking at here, and I'm sure you're tired of seeing this, is just talking about money markets. And as we've seen, it's still been a large buildup in money markets. It's a 3x increase from the 2017 level. These are levels we've never really seen before. Um, and these are the first places that you'll see it. So a lot of you use Flourish, and which would be considered a money market fund. And as you saw, the Fed cut rates on Wednesday. You got an email Thursday morning letting you know that rates have been lowered from 4 to 3.75. And guess what? If we get another cut in October, if we get another cut in December, you will be getting that same email the next day. Depending on what the cut was, that's what you'll be seeing the next day. So this is our last call to implore you to please reach out if you are sitting on cash that you have no plan on spending in the next few years. We've already had numerous calls and numerous conversations with clients, but we still see it across the board that there's just such a big cash buildup. And sure, people have reasons, whether they're immediate spending needs or some reason in general why they need that cash. But I think in a lot of instances, there's no reason other than, well, I like the yield I'm getting right now. And people are creatures of comfort and they don't want to make a change unless they absolutely have to. And we're just trying to sound that alarm, letting you know that it's getting to that point and to start looking at other options. A few of which are being things like multi-year guaranteed annuities, which if you're willing to give up liquidity for a few years, we can get you somewhere around 5. If you're willing to go longer, it can be even higher. And then if you're a little bit more if you have a little higher of a risk tolerance, we could look at bonds from that point on. And if you really want to go for it, I mean, value stocks are still, like we talked about in the last episode, they have not rallied off of the Liberation Day lows like the growth stocks have. We believe that there's still plenty of room to run there. And then, especially with a broadening of the market where we could hopefully stop seeing just 7 stocks driving all the return, the Mag 7. I think myself and yourself, Mike, are just sick and tired of talking about the Magnificent Seven and just the concentration in the market. And I mean, eventually that has to shift.
I think one of the things that we want to stress here is that there is a time element here, and it is going to go away. All right.
Mhm.
So you're absolutely right, Bepin. It's not just rates are coming down. We don't know the path of rates. All right. The
Mhm.
Fed has said they're going to cut rates one time next year. You know what that means? That Jerome Powell might cut one time next year. It doesn't mean whoever is going to replace him in May is not going to do more. A year from now, in my opinion, and look, I know we joked around about economic forecasting, but there are certain times when the writing is so clear on the wall where rates are headed. All right. They're headed down. All right. And that is a problem if you wait until they go down. All right, your 5% you just quoted on that MIGA annuity, okay?
Yep.
Or maybe in the bond market, whatever it might be, that's 5% today.
Yeah.
Okay. If rates continue to come down over the next 12 months, and then you wake up one day and you said, hey, you know what? That Flourish cash account's only paying me two and a half. That's no good. I'm losing to inflation at that point after taxes. Guess what happens? You call up Bepin, you call up Matt, you call up the team here and say, hey, I want that 5% MIGA annuity. You know what they're going to tell you? Yeah, that doesn't exist anymore. That's the problem you're running into is if you sit around and you wait, these opportunities that we're talking about today are gone and they are not going to come back. That's the challenge that you're facing right now.
This is an area that is less talked about in the market. I know we've beaten the Fed to death here with talking about rate cuts, and that's just really to get to sound the alarm, letting you know that time is running out there. But one of the probably the least talked about areas of the market, especially this year, has been small caps. One thing that also happened last week when the Fed cut rates is small caps hit a new all-time high for the first time in almost 4 years. It had been a 4-year bear market in small caps. These are I don't think we've seen a bear market in large caps since '08 that lasted anywhere near something like this. This is essentially, I think, the same amount of time that it took from '08 to a new all-time high. Because I think what '08, 2012, 2013 was the first new all-time high they hit from since the bottom of or since the top of '08. Very similar thing almost happened in small caps, except that it wasn't a great financial crisis that caused it. Lack of interest, less companies becoming public. There was obviously a whirlwind of things that caused small caps to underperform, but we're finally starting to see the green shoots. We're starting to get onto the other side. And this is an asset class we've been overweights for over a year now. And sure, I know we were sounding off a little bit of a victory lap there if you look at the end of 2024 there when small caps look like they're about to break out of a new all-time high, and then boom, inflation expectations. Then you got the Liberation Day sell-off, and now we're finally shaking all that off and getting back to the fundamentals. And again, the fundamentals are rates are coming down, and as you see, that's one of the main drivers of the push to a new all-time high is rates got cut. And then you add in AI, and I think small caps will be some of the biggest beneficiaries of that. As you know, the small businesses have the hardest part is getting labor, getting talented labor, because the big boys suck all the good labor up. And it'll be helping with efficiency. And obviously, this is actually one of the calls, speaking of forecasting, that Matt and Steve made earlier this year. I think one of the predictions was that small caps will outperform large caps. At first, that prediction looked absolutely dead in the water. As you can see from the Liberation Day, this is a substantial sell-off relative to large caps. But obviously, looking now with the rebound that we've seen, that prediction's not looking crazy. It's not looking as crazy as it did if you checked in April. And let's see where we would go forward from here. Now, obviously, it had a good run this year. It's up almost 10%, but we believe there's a whole heck of a lot of room still left to run. What you're looking at here is the different forward price to earning ratios. You can think of this as like a valuation metric. The higher this number, typically the more overvalued or higher valued things are. That dotted pink line you're looking at is the Mag 7, obviously the largest drivers of return, the largest portion of the S&P. These can be considered as like mega cap companies. And then you're looking in the red as the S&P 500, the large cap index, also near all-time highs. Looking back, it's the only times you can see on this chart that look higher were pre-dot-com era. And then you got the blue and green line, which is looking at mid and small caps. And if you look at those lines, those are, if you make a quick trend line in your head, those are still below trend. They're still relatively cheap. And what's actually ironic about this, and one of the reasons of what kind of got us into this idea that like small caps is a great time to increase our allocation. Now, we always held small caps because we're diversified investors and we don't make all in or all out calls. So when I tell you that we increase your small caps, don't go check your accounts thinking you're going to see a 20, 30% position in there. We're talking about a few percentage more than the benchmark. But One of the reasons we did that was because of actually something that you're probably very quite familiar with, Mike, that this actually originated from the University of Chicago, which is the Fama French model, which identifies three factors that explain 90% of portfolio return. It's kind of the cornerstone of financial analysis. And one of the variables that it highlights in that analysis is the size premium, which might sound like, oh, size premium. The bigger you are, the bigger premium you should get. It's actually the quite opposite. It's the smaller you are, the bigger premium you should get. And the reason being is because it's very intuitive. Like a smaller company, it should be easier for them to 100x than a larger company. A quick way to do this in your head is like imagine $1 billion company going to $100 billion. That's not crazy at all. That happens. That actually happens all the time. Look at Nvidia. In their case, it went even higher, but it happens all the time. But could you imagine Nvidia going 100x from here? Like a $1 trillion company becoming a $100 trillion company, 5 times the size of the U.S. economy right now. That seems very, very implausible. So the model states that if you're a smaller company, you should have a higher premium, more of a lofty PE, let's say. But that hasn't been the case. And honestly, that hasn't been the case since really coming out of '08 was the last time that the markets made sense on a fundamental basis where you should see small and medium-sized companies at a premium. But that's why we still believe going forward that small caps should have a whole heck of a lot of room to run now. We're not like Tom Lee, if you see him on CNBC saying that they could have a 100% rally here in the next 3 months or anything like that. But we really like the alternatives to large cap growth. You know, that's what we've been talking about for the last few episodes here. I think the last time we talked about value stocks, we love value stocks. We talked about international a few episodes ago. We love the international stocks, and we think that they're going to continue to grow as well. And we surely love small caps. So these are areas to keep an eye on. You won't hear about this on the news. They don't talk about these. They talk about the mega cap companies, but there's a lot of value to be had here. And obviously, we're always looking to add extra return for our clients when we can. And with that, we'd like to thank you for tuning in. If you, again, I'm going to give you one last chance here. If you got extra cash, please reach out before it's too late, before rates come down and some of these yields that we were talking about earlier just aren't available. But with that, have a great rest of your day. Enjoy your weekend, and thank you for tuning in. Bye.